Hi, guys. Welcome to Wake Up Wednesday with Tina Williams. Okay, over the last few days. Um, if you're looking at this, make sure that you comment. Your type of business, the industry that you're in, and give yourself a shout out of your business. Also, I just want to say, I want to thank Linda Nosby and Ryan DeMarco Anderson from Comerica for coming out to the nonprofit course that we do quarterly last night. They brought the noise. They brought, how you get grants, why they fund. I mean, so the funders were actually on the call talking to a small group of nonprofits that are trying to learn how to get grant funding for their nonprofits. And I'm telling you, it went into the nitty gritty. I mean, Ryan DeMarco Anderson actually went through a 990 and looked at items and told us items, read through it for on your 990, what should be there, what shouldn't be there. So again, I want to thank Comerica Bank, Linda Nosby, and Ryan DeMarco Anderson for coming out to our nonprofit class last night. All right. So the last time we were here, we were talking about business planning. We're going to get right into that right now. The last time we talked, we did our startup table. We kind of going to give you an overview of what we have been doing. So we have a startup cost of $182,000 for our business that we said we were going to get. We're going to do a lemonade stand business, and we decided that we were going to buy the ones that go at the state fair, and that we were going to have 3 of them, and that we were going to end up going to each different fair around the world, well, around the United States. And so we were going to be delivering that. We have lemonade, flavored lemonade, and water that we're going to be selling. We said we were going to be selling. We saw that each fair had about 40,000 people per day walking through it for a 10-day period. We said we were going to get 5% of those people walking through that fair with, hot kids that want some nice fresh lemonade to buy lemonade, a flavor lemonade, or water from one of our stands. And we're going to have 3 stands at each fair. We were going to sell them for $7 for the lemonade, $10 for the flavor lemonade, and $5 for the water. And we said that our cost is going to be 15% to make the lemonade that has lemon, that has sugar, it has water, it has a cup that you have to put with a lid and a straw. So there's some direct cost with that. And then, of course, you buy the bottled water already bottled. So we're going to have 50% on that. We're going to mark that up. We decided that we are going to have an owner, which is you, an operation manager, a site manager, because we'll be at, you won't be traveling with the lemonade stand to every state, most likely. And then you're going to have general labor. The general labor, since it's only 10 days a month, we're going to use something like Kelly Services or Manpower to man the lemonade stand during those 10 days in whatever state we're in. So that's what we decided to pay. And so that means we were going to have 3 people per lemonade stand per month. So that's 9 general laborers and a site manager and an operations manager and yourself. We decided we're going to be going through, we did our profit and loss. We saw that we were going to be, had some monthly expenses. And now what we're doing is we're just going through the break even. So based on this monthly units, we need to be selling about 7,200 cups of lemonade, water, or flavor lemonade in order to break even. But we did say that we were going to be around 63,000 units for the year because we were going to get that 5% of people walking daily through the fair. So now let's go into our cash flow. So we're going to look at what things that are in a cash flow. So the first thing here, are we going to have any new current borrowing? So this just means that, throughout the year, do we plan on borrowing something new? We already know that we're going to be borrowing $182,000. I'm not going to plan for us to borrow anything new. I'm not going to plan for us to have any new long-term liabilities as well. We won't be selling any current assets. So I'm going to put 0 for that. And we're not going to sell any long-term assets as we didn't start the business with any long-term assets. So now let's talk about sales tax. Well, this particular software calculates sales tax. So if you're in a state like Michigan, your sales tax will be 6% if you are selling a product. So you want to make sure that you have that. Now here's the thing. Did we borrow any current borrowing? So current borrowing is anything that we're going to pay back within a year. We didn't say we were, but we did say we were going to borrow a loan of $182,000. Now, in the interest of time, I would generally at this point go to a payment calculator and go and see what the payment would be on $180,000. But for time's sake, I'm gonna put $1,500 a month here, and we're gonna estimate that this has a 10% interest rate, and that will go on our sheet to show interest expense. So I'm actually going to just put that we're going to pay about $18,000 a year in principal. Let me just make sure I got that right. $18,000 a year in principal. There you go. And then that way we have that. We're not going to purchase any new long term, and we're not going to declare a dividend. So now look at that. We do have a positive cash balance here. So today we did go over break even. So let's go back over that. Let's go back over our break even here. And we see that. And we also went over cash flow statement. See how easy that was. The cash flow has our expenditures, our cash spending, our bill payments, any type of sales tax, principal repayment. This is where you'll see your principal payment of repayment of your loan. And then next, we're going to be going over a balance sheet. So stay tuned for next week. Thanks, guys, for joining me today. Again, comment where you are viewing from. If you like this type of content, that really helps me. Share. It really helps me as well. And you can give us a call at 248-416-1755 if you have any specific needs. All right, guys. Thank you.